Welcome to the Deep Dive, where we unpack the most complex corporate reports to give you the critical insights fast.
Today we are jumping into the fiscal Q2 2026 results from Aehr test systems, which dropped after hours on January 8th.
And this one is a classic case of high-stakes volatility. Our mission here is to figure out why a company that just missed its revenue target by 20% is, at the same time, forecasting a potential $80 million bookings ramp.
Exactly. This isn't just a simple miss. You're watching a crucial semiconductor supplier try to pull off a massive strategic pivot. They're moving away from a big concentration in the electric vehicle market.
Specifically silicon carbide, which is softening.
Right. And they're driving straight into the high-power world of AI and data center infrastructure. It's a huge gamble.
So let's start with the immediate damage, because the market did not take this well right after the bell.
No, it didn't.
Revenue landed at just $9.9 million. Yep. The consensus estimate was $12.42 million.
Right.
That's a 20% miss. And it's a 27% drop year over year. I mean, that's jarring.
And that weak top line, it just flowed right down to the bottom. GAAP EPS was a loss of 11 cents. Non-GAAP was a loss of 4 cents.
So a miss across the board. Every key metric.
A complete miss. Confirmed the near-term pain, for sure.
The stock traded down about 4.5% in response. But here's an interesting little detail for you. The options market had priced in a potential 13% move.
So in a strange way, the market was braced for something even worse?
Exactly, which might explain why management's tone was described as, cautiously bullish. That's a pretty big disconnect between the numbers they just posted and the narrative they're pushing.
It is. They're basically asking investors to just ignore the fire right in front of them and look at the blueprint for a new building. They called the quarter softer than anticipated, and then immediately started talking up their significant progress in AI.
It's the ultimate show-me story, then.
Absolutely. The market is saying, fine, we hear you, but we're focused on the losses until you actually deliver on those bookings.
Okay, let's talk about the financial pressure. Because a miss that big has to be putting some strain on the balance sheet. Non-GAAP gross margin fell off a cliff. It's at 29.8%, down from 45.3% a year ago.
Yeah, that's a huge contraction.
What drove that?
It was really a double whammy. First, you have lower sales volumes, so your fixed costs eat up more of the profit. And second, they had a really unfavorable product mix.
Meaning less of the high-margin stuff.
Exactly. They saw a lot less of their high-margin WaferPak revenue, so the sales they did make were, for older, less profitable systems.
And at the same time, they're still spending. OpEx was $5.7 million. With R&D spending actually up. So they're committed to this AI pivot, right?
Oh, absolutely. They're funding the pivot, burning cash now to get that future revenue.
So how are they funding it?
Well, their cash position actually went up to $31 million from about $24.7 million in Q1.
Wait, it went up? How?
They raised $10 million using their at-the-market or ATM equity program, and they still have another $30 million available on that facility, so it gives them the breathing room they need to get through these next few quarters.
Got it. Okay, so now we have to look at what actually caused the Q2 slowdown. Management was pretty direct about what went wrong.
Yeah, they didn't pull any punches. There were two specific headwinds. First, they had a $2 million shipment of WaferPak systems for gallium nitride or GaN power that got delayed.
And that wasn't a demand issue, right? It was an execution problem.
Right. It was a technical snag. They ran into some kind of unanticipated high-voltage bolt condition. Basically, they had to go back and redesign the WaferPaks and the protection circuits. It's complex stuff.
And the second headwind really just confirms why this pivot is so urgent.
For sure. The industry-wide slowdown in silicon carbide demand, the C-fray stuff for electric vehicles, is pushing all their expected system orders way out into the next fiscal year, FY27.
That used to be their growth engine. Now it's an anchor.
A total anchor. This quarter proves the pivot to AI isn't just a good idea, it's a necessity.
So that's the near-term picture. Execution delays and a weak EV market. But you don't raise $10 million just to manage a decline. Let's turn to the optimism. The booking numbers.
Okay, so Q2 bookings were $6.2 million, and the backlog was $11.8 million. That's the baseline.
Right.
But the key thing is, early in Q3, they've already locked in another $6.5 million in new bookings. And that includes a big order for their high-power Sonoma system from a major Silicon Valley test lab.
So that brings their effective backlog up to $18.3 million. A much healthier bridge.
A much healthier bridge. And this leads us right to the core of their new story. They reinstated guidance for the second half of this fiscal year.
And the numbers.
Revenue is expected between 25 and 30 million. Still a non-GAAP EPS loss, but it's improving to somewhere between a 9 and 5-cent loss.
But that's not the real attention grabber here, is it?
Not at all. The big number, the one that got everyone talking, is the bookings outlook. Management says their customer forecasts imply second half bookings, not revenue, bookings of $60 to $80 million.
Whoa, wait a second. 60 to 80 million? That's what, nearly 8 times their current quarterly revenue? How is that even plausible? That's an astronomical jump.
And you're right to be skeptical. That was the central question on the call. The sheer size of that range tells you they're banking almost everything on one segment.
AI.
100%. The bulk of that 60 to 80 million is focused squarely on AI processors. They're targeting both wafer-level burn-in, or WLBI, and the more traditional package part burn-in, PPBI.
Okay, so let's break that down for the listener. Why is this shift to wafer-level burn-in so critical for next-gen AI chips?
It all comes down to cost and yield. This is their big competitive advantage. As these AI chips get insanely complex, we're talking multiple compute chips plus stacked high bandwidth memory, or HBM, all on one package.
The cost of that finished package just skyrockets.
It skyrockets. Management literally said the cost of the substrate and the HBM memory can be more than the compute chip itself. So if you assemble that whole incredibly expensive module and then find a defect during testing...
Just throw the whole thing away. A hugely expensive piece of scrap.
Exactly. WLBI moves that stress testing upstream to when the chips are still on the silicon wafer. You find and scrap the failures early, and you save an exponential amount of money. Their Fox XP system is built for this, and it's why they think they're essential to every major AI roadmap.
So what milestones did they give to back up this confidence?
On the WLBI front, their lead AI customer has already requested additional capacity and is planning to move toward their fully automated system. That signals they're scaling up.
And on the package part side?
Their lead customer there, which they called an AI ASIC hyperscaler, is forecasting huge growth and has already requested shipments of their Sonoma systems to start in Q1 of next year.
And the power specs on these new machines are pretty incredible. It really drives home the extreme demands of AI.
Absolutely. The new automated Sonoma system can handle up to 2,000 watts per device.
2,000 watts.
Yeah. I mean, you're basically testing a chip that's acting like a miniature space heater. It's a massive leap in power handling, and it proves they're right at the cutting edge of the data center.
And they're not just betting on AI. They stress diversification, moving into GaN power, data storage, silicon photonics. I want to go back to flash memory for a second.
Yeah, that was interesting. Their benchmark with a global flash memory leader is done. And the conversation has shifted from, commodity SSDs to this new thing called high bandwidth flash, or HBF, which is designed for AI workloads.
And it has a power problem, as they put it.
Exactly. These new memory stacks generate so much heat that standard test equipment can't handle it, which is, of course, music to their ears. Their whole value proposition is solving that exact heat dissipation challenge.
Okay, let's circle back to the skepticism. They're talking about an $8 to $15 billion total AI test market.
Yeah.
And they think their business could be hundreds of millions of dollars annually. How do they justify that kind of market capture?
Their argument is that they've already locked down a huge chunk of the market for the Sonoma H2O testing, the packaged part method. And that gives them a front row seat, as they say, to then go and pitch the much more expensive, higher margin Fox WLBI systems for the customer's next generation chips.
So the strategy is land and expand. Get in the door with the package test, then upsell them to the superior wafer-level solution.
Precisely. Qualify the device in the package, prove you can handle the power, then convert them to the more lucrative solution over time.
Which brings up the classic analyst question that came up on the call. Cannibalization. If the wafer-level solution is so much better, won't it eventually just kill their packaged part business?
Yeah, and management had a good answer. They don't see it as cannibalization. They see it as a natural, positive evolution. PPBI systems are the high-volume workhorse today, but the huge yield benefits of WLBI make it the clear long-term winner for the most complex chips.
So they're pursuing both on purpose.
Right. It's a dual-track strategy. It guarantees they get a piece of the business no matter which method the customer prefers or where they are in their product cycle. It's a smart way to de-risk it.
Okay, final point. For an $80 million ramp to be credible, they actually have to be able to build and ship all those systems. Do they have the capacity?
They hit that one head on. Management stated they can manufacture and ship 20 systems a month combined of both package and wafer-level systems.
Which is way more than they need for the current forecast.
Way more. It was a clear signal that the factory is ready for the ramp if, and it's still a big if, those customer orders actually come through.
All right. That brings us to our segment where we explore ideas based on what we've learned. And just a reminder for everyone listening, this is purely speculative. It is for educational purposes only. This is not financial advice.
Okay. So the key here is to exploit that massive divergence we've been talking about. The ugly Q2 miss and the sequential weakness dragging the stock down now versus that huge AI bookings forecast for the second half of the year.
So you're playing that specific timeline, the pain now versus the promise later.
Exactly. The outrageous but plausible trade idea is to fund a really high-conviction, long-dated, synthetic long position. You do that by buying call options centered on the Q1 fiscal 27 timeline.
So right after that big bookings window is supposed to close.
Precisely. You're betting that this air pocket phase ends exactly when the AI revenue ramp is scheduled to begin. You're using that elevated volatility that's keeping option prices high to your advantage, anticipating that the 60 to 80 million in bookings will translate directly into strong revenue growth right at the start of the next fiscal year.
That is a very targeted bet on management's ability to pull off a perfect strategic pivot.
It is.
So to recap our findings, a really painful Q2 miss, no doubt about it, driven by GaN delays and the EV market slowdown. But management has successfully, at least for now, re-anchored the entire story around a potential $60 to $80 million bookings ramp.
Driven almost entirely by their diversification into AI and the critical need for wafer-level burn-in technology. It really sets the stage for a potentially massive fiscal year 2027.
Okay, and let's leave our listeners with one final provocative thought.
Here it is. We know the shift from cyclicality and EVs to high-power AI is a necessary move for the company. But think about this. If AI adoption of WLBI really takes off because of the huge cost savings, could that force the legacy cyclicality and EV customers to accelerate their own move to this more efficient technology just to stay competitive? If that happens, you could see the AI boom compound with a resurgent SiC boom in FY27, create an even bigger market spike than anyone is currently forecasting. Something to think about as you watch those booking numbers come in.